everyone. Happy Thursday afternoon. My name is Michael Valtos. I'm from Orderflows, and today I'll be talking about using order flow to find price rejection and how you can take advantage of it to profit from it. And my goal today is several goals, actually. I want to teach you what price rejection is and how to profit from it, why price rejection allows you to catch trends when they begin, show you how to see price rejection using order flow. And then just really briefly, I don't want to spend too much time talking about me, but just so you know who I am and where I'm coming from, and the information that I talk about comes from real world trading experience, not some theoretical, simulated trading environment. I have been in the trading industry for about 25 years. I started on the CME floor with Dean Winter Reynolds, that's back in the early 90s as a runner. I started literally at the bottom. Then I eventually left the trading floor when electronic trading started picking up, and I worked on the upstairs trading desk for about 3 years. I joined the English trading company, EDF Man. I was there for 2 years on their global macro desk. I spent 4 years with Cargill as a trading desk manager. We traded literally every single thing you could imagine under the sun that's tradable. 3 years with Commerzbank, the big German bank, as a licensed Eurex trader, traded all the German interest rates and stock indices. And I spent 8 years as vice president of futures trading at JP Morgan. And it was an actual trading job, executing trades all day long. I mean, it wasn't like I was just sitting at the office looking at a spreadsheet and coming out and saying, hey, you know what, you got too much risk on or anything like that. No, I was actually trading day in, day out, coming in the office at 5 in the morning, leaving at 5 at night. But for the last 3 years, since 2015, I created my own company, Orderflows. And what it is, it's a software and education company. It's a way for me to spend more time with my family and also be involved in the markets and work with traders that want to learn more about trading. And people will always say, oh, if you're such a good trader, why aren't you trading? Why do you spend your time wasting your time teaching people how to trade? Well, the way I see it is, one, it's a way to give back. When I was starting in the industry, it was easier to talk to successful traders because there was a trading floor. If you're on the floor, you have access to some of the greatest traders in the world. But now it's very difficult to get started in the trading industry unless you go to the right university, get the right degree, and get lucky to get selected in the interview process at a trading firm. They're highly selective now, and times have changed. So so what do people do is they look online for information on trading, and honestly, a lot of the information online on trading is written by people that haven't traded, or they just trade part-time. But my background is as a full-time institutional trader, and I just want to impart that knowledge that I've gained over the years to other people. So what I present here is what I've developed for myself and built my trading career on. I hope you can find the things that fit into your trading or things that you could adapt to your trading style. Now, again, I'm not saying you have to follow what I say just because I say it. You have to evaluate everything you come across from me or elsewhere. Like the previous presenter, Fausto, I watched his presentation and it's very interesting. I may be signing up for his course as well, because it's always about taking yourself to another level. You have to keep going on. Trading is a journey. It's not like you just reach a destination and that's it, you stop, you know everything. No, markets are always evolving and there's always new ways to analyze and approach the markets. So again, you have to evaluate everything you come across, either from me or elsewhere, and decide if it's going to help you. If not, then you just reject it. One thing people tend to forget is that in trading, you have to make decisions. Nowadays, with computers, everyone wants everything to be automated. But as a trader, you should learn to make your own decisions. And order flow is not necessarily a red light, green light trading system. What it will do is it will highlight areas to you, that points in the market where things just really stand out and make perfect sense. Once you understand the order flow, things just become very clear. And if I hate to sound like I'm a cultist or something, but honestly, once you start looking at order flow and you understand some of the concepts, then you really understand the whole supply and demand dynamic, what moves the market, when activity is drying up in one place or another. And before I jump into everything, I just want to go through a brief disclaimer. This presentation is for educational and informational purposes only. and should not be considered a solicitation to buy or sell a futures contract or make any other type of investment decision. Futures trading contains substantial risk and is not for every investor. An investor could potentially lose all or more than the initial investment. Risk capital is money that could be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. Again, I don't necessarily have to go through that disclaimer, but I just want you to know up front, there is risks involved in trading. You can lose money. Sometimes people don't understand that, and then when they lose money, they panic, because sometimes it may be money they can't afford to lose. Don't put yourself in that position, because what that does, it just gives you an extra level of stress in your trading that's going to affect your performance. All right, so let's jump into it. What is price rejection and how to profit from it? Now, price rejection is not really something that many people talk about, and there's a reason for it, is because to understand price rejection, you have to understand what's being traded in the market, and the way to understand what's being traded in the market is to look at volume. Now, just take a step back for a second. Over the last 5 years or so, I've worked with a lot of retail traders, okay, and a lot of them have been unsuccessful in their trading. Everyone has different reasons for it, but one of the reasons that I find that traders fail is because, one, they rely on indicators, and two is when you start relying on indicators, you treat every price the same. By what I mean the same is equal, right? So every price is not the same, in the sense that it's not created the same. Some prices are created on average volume, some are created on heavy volume, and some are created on light volume. And there's different meanings that is implied by the volume that's traded. I mean, Fausto just made a great presentation on order flow, and the same thing also applies when you're looking at price rejection and price support. The market exists to facilitate trade. Find price levels where both buyers and sellers can trade and be happy. In other words, find a fair price. It's when the market finds a fair price, it's looking for another fair price. Once price is being rejected, the market's going to go up or down and look for a new fair price. That's what causes the markets to move. So as the market moves up and up, as traders buy and buy, oftentimes it reaches a level, a new high price, where traders think it's too expensive. So they don't want to buy anymore. So the buying activity, even though there's still stronger buying activity than selling activity, that's why the market's moving up, the buying activity slowly starts getting lesser and lesser. Eventually selling takes over and the market starts to go down. And the opposite is true when the market is moving lower and lower as traders sell and sell. The market reaches a point where the sellers are just like, hey, you know what, this is too cheap. I don't want to sell it at such a low price anymore. And they stop selling, they reduce their selling. And then what happens is buying starts coming in, because buyers are realizing, hey, you know what, there's not so much supply anymore. The selling is getting lesser and lesser. Buyers start getting a little bit more aggressive and start moving the market up because there's less supply. Everyone always talks about, well, you got to understand supply and demand. That's it right there. When supply gets less and less, the buyers start buying more. When there's a lot of supply and less buyers, price goes down. Now, oftentimes, if you were to search on the internet for price rejection, you often come across charts like this, where someone says, well, price tested a level, then reacted off it, so that's price rejection. Actually, that's not what that is. It's a price level rejection, not necessarily price rejecting a certain level. I mean, you don't know if this market, if at this level, when you came back up here, if buying is lesser or if there's a big offer up there, a lot of supply. If there's a lot of supply, it can mean one thing, but if buyers aren't interested in buying at this level, that's going to have a different implication. Because if you come back and test this level, if it's just the resistance level, if you get past that level, you can keep going higher, because once the resistance is taken out, but you have a lot of buying pressure, it's going to go up, right? So to look at a simple bar chart and say you have price rejection, I think is a very big stretch for a trader, because you don't know if it's really rejection or if it's a lot of supply or a lot of demand. Now remember, no market's going to move in one direction forever. At some point it's going to become too expensive or too cheap. And at that point, that's where price rejection often appears. because traders, right? Traders are the ones that, do the buying and selling. They're the ones that say, you know what, it's too expensive for me. I don't want to buy here, or it's too cheap. I don't want to sell here. And they're rejecting those higher prices or those lower prices. Now, when dealing with price rejection, most people are familiar with Japanese candlestick charts. And, in the early 90s, when candlesticks were in vogue, popular, I was also into Japanese candlesticks. And there's literally hundreds of patterns that you can look at. And when they work, everyone sticks their hands up and said, yes, the candlestick worked. But when they don't work, you don't hear anything of them. But they like to say that, hey, you know what, these are rejection, market is rejecting these levels, like this double bottom here. Well, is it rejecting this double bottom at this level because traders don't want to sell there, or is there strong support? It's price rejection sort of gets lumped in with support and resistance when it really shouldn't. If you're looking at the volume that's being traded, and you can see that every time it comes down here, the selling gets weaker. Then you come down here the second time and selling gets weaker, and then markets rally both times. That means one thing. If the market comes down here, you have strong selling, but you have a big bid here, and the market rallies back up. And the same thing, you test it again, but it meets that big bid there. That's going to mean something else. Yeah, they can both rally, but if you have a strong support level, okay, and you come down and test it, and then you break it, what's going to support the market? The market's going to keep selling off. What you want to know with price rejection is the sellers. Is it strong still, or is it weak? And if it's weak, that's a sign of price rejection. I mean, you could still have strong sellers, but the buyers are too strong to support the market, that they're overrunning the sellers. But if we're coming down into these lows, and as you're coming down, selling is half-hearted, and then you start to rally, then you test it again, and selling is even weaker the second time, and then you start to rally, that's just going to tell me that, one, you have weak selling, weak interest to move the market lower. So if you got weak interest to move the market lower, it's not going to go lower. But if you have strong selling that's running into a support level, and then eventually you test it again, and finally you break through it, well, what's going to happen? The market's going to go lower because you still have that strong selling. But if I can see on this bar that selling is weak, then I'm not too concerned that we're going to break through here, because I know selling's already weak. The best way to describe it, I think, is, if you have a sink, right, your kitchen sink, you're running water, and you hold a paper towel under it, okay, and the stream is constant, okay, it's a strong stream of water coming down. Eventually, that paper towel is going to break. It's going to become a hole, and water's just going to keep flowing right through it, which is the support is broken. Now, if you're holding the paper towel, but then you slowly start turning the sink on weaker and weaker and weaker, but the support is still the same, but it's weaker, the selling, the water coming down is weaker, and then eventually it dries up, well, that support's still going to hold there, right? And then you'll have a support level with your paper towel. But that's what price rejection is. And sometimes a lot of people don't understand the concept. They think that if a price trades there and it bounces off there for whatever reason, whether it's support or resistance or price rejection, that it's automatically price rejection. They're bastardizing the word price rejection in the sense of it's rejecting a level for whichever reason that sort of encompasses it, sort of like the Mueller probe. But price rejection, honestly, is difficult for some people to understand, but think of it in everyday usage in your life. I say in the grocery store, I use that example a lot. The jewelry store, even in dating, right? If you're, there used to be the prettiest girl in school sometimes, wouldn't get asked to the dance because, everyone is too afraid to ask her because she's so pretty, so beautiful that nobody wants it. She gets rejected because she's too beautiful. And it's like with price, sometimes price gets too high, traders don't want to buy anymore. And it's the same thing. You go to a jewelry store and, they have a diamond for sale for $100,000. Well, people that buy diamonds, there's a certain market, and not everyone's going to be able to afford 100,000. There may be a small amount of people, and maybe 3 or 4 people that can afford it, and even then, they may not want to buy it at 100,000. They may think it's worth less. So there's no buying interest up there. So people are rejecting those higher prices. Now, again, price rejection is nothing new. It's a fundamental aspect of the market that's overlooked by many traders just because they can't define it. And order flow is going to help you define it because you look at the volume. Otherwise, you're just guessing. Now, when you're able to identify that prices are being rejected, you can position yourself in the direction of the ensuing move. And oftentimes price rejection occurs at market highs or lows. But more importantly, this is important, a lot of people don't realize this, is price rejection can also appear just after a high or a low is made. And what do I mean by that is you hit a high, start to come off, make another run up at that high, but the second time the buy-in is getting weaker. Okay, it may not take out that high or reach that high. It may just come up within a few ticks of that high, indicate price rejection, and then sell off. All right, and again, if you're looking at a normal bar chart, you're not going to be able to pick that up because you're more focused on the recent high, whereas you're not necessarily focused on the bar immediately afterwards. And again, if you can determine if a high or low is being made, it's going to present you some great trading opportunities to catch big moves. Okay, so this is a chart. This is an order flow chart. Later I'll show you some bar charts, but price rejection, down here on the bottom is a sign of price rejection in the order flow. Later I'll show you how to see this in the order flow. But for now, I'm just going to show you how the markets can turn. This is a bottom that this is on a 5-minute chart in E-minis, or sorry, Euro currency. And for 15 minutes, basically, you've been trading right around this low. And then on this last bar, there's some signs of price rejection in the order flow. And what happens? The market takes off, makes new highs. Here's another example. Okay, we hit our high, the swing, kind of a swing high up here at the very top. Got some signs of price rejection. You start coming off, and then a couple bars are also exhibiting price rejection at the end of the bars. So you start selling off. Then again, you're starting to, maybe come back up. You got this green candle here right before you get the third sign of price rejection, and then the market just sells off because you're seeing up here, traders are rejecting these higher prices now. And that's important information. Again, this information is available on regular data that comes from the exchange. You don't need level one, or so you need level one is your basic data that you could get, from your futures broker for just, $5 a month. You don't have to pay anything extra for level 2 or anything like that. It's just the data. It's about having the software that can put the data into an easy to read format so that you can analyze it and make those trading decisions. So what happens is this market has a nice sell-off, boom, 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 gets down to this low where you have price rejection down at this low. And what happens is the market starts to rally. And just to touch on the part of price rejection just after the high, you have this high right here, and then the bar afterwards, you got signs of price rejection. So what happens? The market's rallying up, 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 hits this high, comes off a little bit, makes a very half-hearted attempt to rally back up, fails, and then sells off. Okay, that's why I talk about just after the highs. You don't always have to look at it right at the high or at the low. You could go in the next bar right afterwards also and look for it. It's a great way to, I think, make educated trading decisions. So again, price rejection, when high prices are being rejected by buyers, is either being too expensive and buyers don't want to pay for something that expensive. I mean, period. You don't want to overpay for anything in life, whether it's food or whether it's clothing. You don't want to overpay for something. And it's just the same thing holds true in trading. Now, the same thing is true when you're selling something, right? If nobody wants to sell something below its value if you don't have to. And oftentimes, if you want to get rid of something, you got to keep lowering the price until somebody buys it. But then at some point, you're like, well, you know what? I'll just keep it. You watch the shows Pawn Stars, and someone comes in with something, and I want $5,000 for this this painting. Okay, they bring in the expert. They say, well, it's only worth $50. And the guy's just like, well, for $50, I'll just keep it. So it's the same thing. With commodities or stocks, if it gets too low, sometimes people don't want to sell it anymore. And then what happens if people stop, if there's less interest in selling, that means there's less supply on the market will just gradually go back up. So the second thing I'll talk about is why price rejection allows you to catch trends when they begin. And to me, this is a very important aspect of price rejection because every trader has access to the same information. It's how you use that information that makes a difference. Again, that's why I say you just need a data stream. You don't need level 2 or anything like that. You could take the data that comes from the exchange, and your software can manipulate it to show you in an easy to read format. And you don't have to guess the future direction of the market. Just listen and watch what the market tells you the direction is going to be. Everyone talks about trade with the trend. The trend is your friend. Trade in the direction of the trend. Let your winners run, etc. We've all heard those, and those are great trading rules. You have to let your winners run. You have to trade in the direction of the trend. But all too often, people don't. Unfortunately, as silly as it sounds, you have to trade in the direction of the trend. And if you're going to trade a trend, what you want to do is you want to get in as soon as possible. Okay, so here, this is a bar chart. Okay, this is a tool I use to indicate price rejection. You have a low with a sign of price rejection, and the market rallies. You got a high up here, you got a sign of price rejection, another high over here rather with a sign of price rejection, and the market sells off. You want to get in as soon as possible, right, to catch as much as the trend as possible, rather than getting in 10 ticks later, 15 ticks later. No, because that's just money out of your pocket. If you can have a way to see the direction of the trend when it's starting to change, then that's when you want to get in. And how do you get in early is you need to identify a market inflection point. What's a market inflection point? Is a potential high or a potential low. And it's going to be a point where prices are being rejected because they're either too expensive or too cheap. And one of the ways, again, I'm going to explain this in a few minutes a little bit further, is single prints. Single prints is an easy way to see price rejection in a bar when you start stringing together bars as they're forming in the greater context of the market in whole. And a single print occurs when the last buyers have bought a high or the last sellers have sold at the low. And the Orderflows software, the Orderflows Trader software, will highlight them on the chart for you. So you can see, these down arrows are buyers losing interest at these higher levels up here. And it's actually, it's a classical head and shoulders pattern just about. And this is the beauty of order flow, is sometimes, people have a way of trading. They have their own form of analysis, whether it's classical technical analysis, or they have their own ways of drawing support and resistance levels. And they always say, Mike, how can I use order flow to help me refine my entries and exits? And basically, maybe get an extra couple of ticks out of a trade, or get a better entry to, again, get a couple of ticks out of trade. Because if you're an active trader and you're able to get a couple of ticks out of couple more ticks out of each trade, at the end of the year, that's going to add up to, a lot in your bottom line. So, if you're using classical technical analysis, you can look for things, signs of price rejections at areas or at formations, or when you're testing a level, to tell you that, hey, price is being rejected at these levels. It's a fairly safe area to get short or get long in. In this case, with this head and shoulders, it's easy. This is you really should have been getting short anywhere, somewhere in the middle of this head and shoulders, rather than waiting for, well, we got to wait to break the neckline and then sell off. No, you could be getting short anytime, after the first shoulder and head is made, because you're already seeing signs of price rejection in the order flow. And this is another one. This is, prices being too cheap. And this is an important concept, is, sometimes people don't realize that, when you're in a trend, when a trend is going, this goes back to the, let your profits run. How can you stay in, how can you have a way to convince yourself to stay in a move? Okay, well, if you're long and you're starting to see, as the market's moving up, and you're starting to see bars where they try to trade a little bit lower, but they're rejecting those lower prices, you can be fairly confident that there's probably more to this move. Okay, so rather than getting out, somewhere in here, you see the sign of price rejection coming in here, so you can catch those next subsequent bars that pushes the market higher. You know, even here, as you're moving up, you're sort of coming in here. You got this period of where market's kind of selling off. You got a few 4, down red candles, and you're thinking, well, maybe I should get out. Then you got this bar here. It will sign a price rejection in this bar. So you could catch the next move up. Then you hit this next level, again, a sign of price rejection, and the market keeps moving up. So, when everyone talks about, you got to trade in the direction of the trend, you have to remember, right, there's momentum in the market. And the best way to describe momentum in the market is like a train, okay, or a boat. If you're in a boat, there's no brakes in a boat, okay? So if you want to stop the boat, basically you put it in, I forgot, it's been a while since I drove a boat, like a neutral, okay, or you just kill the engine, and the boat's going to start slowing down. And the momentum is still going to take it forward, but the boat's going to slow down, and it's going to get to a point where there's no more momentum and it stops. And the markets are the same way. Trends are often the same way. They end when the momentum is getting weaker, the aggressive buying is getting weaker. They're still buying, but it's dissipating. It's getting weaker and weaker as the market's moving higher or lower. And that's what price rejection is. It's the momentum is getting weaker as buyers are getting weaker or sellers are getting weaker. They're still buyers, but the number of them, their interest is getting smaller. And it can also be used for confirmation that you're on the right side of a trend, like I just showed you. Let's go through a couple more examples. This is Bunds, right? Bunds, it's a great market for order flow. It's a great market for people that work during the day because you can trade it before you go to work, or I know some people that are fortunate to trade during work as well. You can use signs of price rejection when you're in a move. Here you have a swing low. It was sign of price rejection. You get in. Oh my gosh, I got my first down candle. I got to get out. Well, wait. You've seen a sign of price rejection in this bar, so you can be confident. Okay, well, I think we're going to go higher and hold it for longer. Staying in the trend, trading in the direction of the trend. If I start seeing price rejection on the upside, above the bars, then yeah, I probably have a different view. But if I'm long and I'm seeing the price rejection, under the bars, as the bars try to poke lower, that there's less selling interest, I'm going to be interested to hold the trade longer. Same thing, got a swing low here. You start moving up, you got single prints all the way here, boom, boom, boom. There's no reason to be cutting that position per se. You can still hold it and take the trade. Let it run longer. Everyone says let your winners run. That's how you let your winners run. Is you read the order flow and you can make a better decision oftentimes. Right off the low here, you got a divergence. You got your positive delta, so you got a new low on the positive delta. And where are you seeing the signs of price rejection? In the bar right afterwards. So we slam down here, okay, but then as we start coming down, you see prices being rejected and the market starts going higher. So there's more than one way to skin a cat. Everyone always wants, I got to pick highs and lows, but you could get in after a high or a low is made. If you think it's a reversal and you're starting to see some signs of price rejection, yeah, by all means, jump in, go for it. So how do you see price rejection in using order flow? That's what you're here for, honestly. I think is you want to learn how to read the order flow to see price rejection. Now there's a hard way and there's an easy way. The hard way is you can take years to figure it out by sitting in front of a screen and watching every tick that goes through and making your own notes. And in a sense, that's what I did for a long time, in my career. But I didn't take actual manual notes. It was just observations as I was trading, and ultimately it formed my basis for trading. But nobody, I said, unless that's what you're doing for a living, you can't do that. I mean, if it's extremely frustrating, it's extremely boring. The markets are boring a lot of times, and often when it gets boring, your mind tends to stray, and you start surfing the internet, or you get a phone call, life gets in the way, and then you're not learning anything. So the easy way is you use order flow software to do that analysis for you. And that's why I released this Orderflow Trader in 2015. And we just recently did an upgrade earlier this year, and it's got tools in there that's going to help highlight price rejection. We have other tools for support and resistance, and other things like sweeps in trap traders. We have a lot of tools, but price rejection, again, is something that doesn't get a lot of lip service, but it's a great way to analyze the market. And I had talked about single prints. That's probably the simplest way. If you have an order flow chart, from any vendor, you can see single prints. Actually, several vendors have been copying a lot of my ideas. Single prints just got copied by order flow analysis. They actually refer to it as exhaustion, which I beg to differ on. And I have more advanced tools such as the ratios and price rejector software add-on. Now, my ratios have been adopted by several other software companies out there, but I just don't understand. It's like, yeah, people say, can you put this in there? But then people don't understand how to use it, and it's kind of pointless to have a tool if you don't know how to use it. And then obviously I have the price rejector add-on, which is a separate indicator, which I'll talk about shortly. But let's start with single prints. What's a single print? Well, it occurs when there's a single volume print, a volume between 0 and 9 contracts at the bottom bid side of a green candle, which indicates sellers in that bar have dried up as the market's moving lower. That's a bullish single print. Okay, now the opposite is true for a bearish single print, which is on the top offer side, the volume has to be between 0 and 9. That's a bearish single print. And how it looks on a chart on the Orderflows Trader software is we put a box around it. You could color it, I color it green. These arrows are pointing at it. And it's just because when people have copied it, they've literally done the same thing, put a box around it. And people, when I first released this in 2015, this information for how traders can look for this, there's been some traders that I know have taken this idea and run with it, and they've told me how they're using it in their trading and how they've become very successful with it. So it's a great starting point if you are a little bit more experienced in trading and have a way of trading, of analyzing the market, and you sort of want to refine your entries and exits. But it's a great tool for finding areas of price rejection. And again, it'll appear in trends, as the market's moving up. You can see single prints 2, 1, 5, 7, appears 1. Then at the very top up here, you got a single print of your first bearish one. Well, actually, you had a bearish one here, and the market sold off as well. So, it's a basic tool that you can use to, once you understand what you're looking at, because people will say, well, okay, I got a single print on my screen, but I don't know what it means. That's what it means. Okay, it's not some order flow rejection price algo or anything like that. No, it's a single print. What it's showing you, it's designed there. The reason I put it in the software is because sometimes I need something to tell me, hey Mike, this is happening in the market, don't miss it. Okay, and the information I said is available to you if your charting software can take that information and put it into a footprint chart so it's easy to read, easy to understand. Now, the second thing I'll talk about is the Orderflows Trader Ratios. It's a proprietary tool I created to help me see where price rejection or price support appears in the order flow. And honestly, I just used to do it in my head or on a calculator. But what they do is they measure the order flow occurring in a bar, and depending on the ratio, it can mean price support or price rejection. In this presentation, I'm going to discuss the ratio which indicates price rejection. Now, again, as I said, a lot of other software companies have taken this concept and put it into their software, but then they don't explain how to use it, right? Every bar is going to have a ratio, honestly. Ratios, there's three types. One indicates price rejection, one indicates price support, and one just indicates your normal order flow that's going through. So it's pretty amazing that I see other software put it in there, but then don't teach people how to use it properly, and it actually does a disservice to traders because they think that they're looking at something that's useful, but if they're not knowing how to use it, it's useless. But it's a very powerful tool, and I have whole trading setups built around the ratios. So when you get my software, you get those access to those trading setups, so you can see and know what to look for. Now, again, I said there's three types of ratios. There's blue ratios and there's black ratios. Black is just your normal order flow that's going through the market. That's why the market exists. It exists to facilitate trade. And oftentimes, over 50% of the bars, maybe more, 70%, are black, meaning the order flow is just what you would expect, and that's what it should be. But there's times where it's blue, which indicates either price support or price rejection. And I've drew the arrows on the bars that indicate price rejection. And you can see right up here at this turning point, price rejection, a little bit off as you're selling off, more price rejection. As you start, try to maybe make another run back up there. Even here, off this low, you got some supportive buying in here in this ratio. The next bar, again, traders are rejecting these lower prices, and you can see as we scream higher to an area of price rejection. But that's how you use the ratios. People don't understand how to use them. And again, knowing how to look for price rejection and use it, use the order flow. That's why, we put these ratios on every bar so you can make that decision. I mean, that's why I said earlier, as a trader, you have to make trading decisions rather than just sort of trying to find a red light, green light system. So here we got a high, you got a divergence up here. You start selling off, then you're going sideways in here. Okay, well, you're going sideways. You got to make a decision. What's the market going to do? It's going to go higher, or is it going to go lower? Well, even in another form of order flow analysis, the point of controls, you have a point of control resistance, you have a point of control support. But what's more telling, as we're going sideways here, so we're in a zone, or I'll say a zone, we're in a period of going sideways, but you got 1, 2, 3 bars in here indicating price rejection. So as the market tried to poke up once, twice, 3 times, it was not met with price rejection, but instead it's exhibiting price rejection. And then what happens? The market falls over. This is S&Ps. It went from 2867 all the way down to 2857. That's a 10-point move in the S&Ps, not 10 ticks, 10 points. Again, ratios. You can see here as we start going up, you got a bullish ratio here. You got a bearish ratio here as you're going sideways. The next one is a bullish ratio, finally pops up. You hit this high here, but then next 2 bars, it's met with bearish ratios. And the market starts trickling down. These are single prints as well. This is great shorting opportunity. When it hits this high, people are sitting here wondering, well, which way are we going? We're going to go test it, go run back up, or we're going to sell off. Well, if you're looking at the order flow and you're looking at the ratios or single prints, you can see, hey, you know what? Price, traders aren't interested in taking it higher anymore, and then the market sells off. Here you got 1, 2, 3 in a row, ratio, and the market just keeps selling off. This is Bunds. Again, this is 2 in the morning Chicago time. So I say, people say, well, I got a full-time job, I can't trade, but I want to learn. Well, look at a market like Bunds that trade in the morning. Bunds is a great market. It follows order flow very well, and I think you can get some very good good trading information from there. So what if you don't want to learn how to read order flow? I say, hey, Mike, what have you got for me that I could learn order flow without having to, sit on a, sit in front of my screen and read it? Well, that's where the price rejector tool comes in. And what it does is it analyzes order flow, it analyzes the imbalance and price action, and it runs on a normal bar chart. That's the beauty of it. The simplicity of it is it takes this and then it'll highlight to you these areas. You have, price rejection, price rejection, price rejection. You're not going to get price rejection at every single turning point, because oftentimes the market turns for a number of reasons. Okay, it's not always about price rejection at every single turning point, but there are times where in the order flow it just reveals itself to you, takes its clothes off, so to speak, and says, hey, check me out. And it's quite revealing. NASDAQ, he's got price rejection, price rejection, price rejection, price rejection. Euro currency, price rejection, price rejection, price rejection. Again, you want to get in on these moves as soon as they happen. This is how it looks on a volume footprint chart. It will run also on a volume footprint chart, on a Renko chart, pretty much any type of chart. Sometimes people come up, they got some weird chart that I've never seen. Will it run on there? It should, but if you're really into some esoteric charting, it may not. But most charts It will. Volume footprint charts definitely, bar charts definitely. Whether your bar chart or candlestick chart, Renko charts, it'll work. And you can see here, um, this was this morning, I think, in the euro currency. Yeah, you're coming into these lows here, and you're seeing prices being rejected at these lows, and we're making a nice move up there. So hopefully by now you can see how powerful order flow analysis is and how it's going to help you see price rejection in the market. Again, don't try to overcomplicate trading. That's the biggest mistake a lot of traders make, is they think, well, I'll just get more and more indicators out there and it will help me become a better trader. No, it's not about more. It's about having good indicators that teach you how to look for things in the market. And if you found this helpful, I think you're going to like the Orderflows Trader 2.0 software package, which is a great way to get into order flow. It works on NinjaTrader 8. It's a volume footprint chart with 7 pre-programmed indicators. And I just talked about single prints and ratios on there, but there's other ones for other parts of order flow analysis. You also can get my chart template, so your chart will look just like mine. It's very easy to set up. It's not something that's going to take you all afternoon. And normally I sell this whole package for $8.99, but that's not what you're going to just get that, because I know that order flow software is one thing. You got to know how to read it. You got to know what to look for. So I provide a lot of further education. Okay, I have an order flows trading course which you're going to get access to, and normally I sell that for $297. And for people really interested in order flow, I'm going to give you access to my order flow inner circle video series. There's 56 videos on advanced order flow analysis, tricks and tips for reading the order flow. Again, knowing this sells for $497, I'm going to give you access to that. And we start adding that together, it's already almost $1,700. But to even make it sweeter, because Investor Inspiration keeps inviting me back, I'm going to give you access to the Trader Kickstart course, which is a simple 12-course instructions on the mental side of trading, the mindset, why traders succeed, why traders fail, how to develop discipline, how to control your emotions. So that's a great, thing that people don't necessarily understand. And you start adding, throw that in there, that's $19.90. But you're not going to pay $1,990. That's a lot of money for a lot of people. It's just a one-time payment, $8.99. Go to orderflows.com/PR HTML. I put the link in there for everybody. Again, there's no monthly payments or other payments in the futures. You just have to pay your NinjaTrader fees or your data fees. But for the next 3 trades, even a special is I'm going to give you the price rejector indicator, which is the indicator that runs on the bar chart. This indicator here for these charts, I'm going to throw that in. That's just for the next 3 people that sign up. It's not something that is going to be available to everybody, so you got to act soon. So together that's $2,200, but you're not going to pay that, right? It's just $8.99. That's it. I'm not going to shake you down for more money like other people try to do. So what you do is you go to the orderflows.com/PR. It takes you to this page. Scroll down. If you see this down here, there's a couple of videos on the page. Once you get past that, you'll see the bonus for the next 3 traders, the price rejector indicator. Once they're all gone, that's it, they're gone. So that's why you got to take advantage of it now. It's going to save you more money, because normally I sell that indicator by itself for $300. I'm going to give you access to that for free. And you click on, I want this. It takes you to PayPal. PayPal processes your transaction, not me. I don't get your credit card information. I don't want your credit card information. But what you have to do is you have to act now, right? You got to go to orderflows.com/PR.html. But again, it's nice to hear me talk about this. I'm a big believer in order flow. That's how I make my living, as a trader in the past, not just now as selling software. No, that's how I traded for 20 some years. That's how I, bought my house, car, everything, paid for my food, put food on the table, is by trading and by using order flow. And Sheila writes, Mike, your Orderflows Trader software is remarkably helpful. I can clearly see now what's happening in the market. For example, who's in control of the market on a very specific time and who's getting weaker as well. I love the idea of yours about ratios printed above or at the bottom of the bar to gauge if price is rejected or defended. Okay, so again, go to orderflows.com/PR and get started.